All right, we'll get started now. So, hey everyone, welcome to AILA's monthly special interest group. My name is Tarraso, and I'm the executive director of AILA. And so, yeah, today our month's topic is around financial risk modeling, and we've got two amazing speakers to go over their view on this. And yeah, so basically the format of this whole event is we have two speakers. Each speaker gives about a 10 to 15 minute presentation, which then will lead into a fireside chat. And this time it'll be a fireside chat with Maciel Osterlin. And so in a little bit, we'll all go off camera, except for Jorge. I believe you're going first. And then after that, we'll have Jay, and then we'll get into the fireside chat. So if you have any questions or anything, please put them in the chat or hold on to the very end, because during that fireside chat, it'll be more interactive, and you'll be able to ask your questions, and Maciel will get our speakers to talk about it. And so without further ado, without further ado, please welcome Jorge on the stage.
All righty, thanks, Todd. So let me share my screen. Do you guys see there the slides?
Yeah, I see it.
Okay, awesome. Well, thanks everyone that's joining. It's an honor to talk here, and just a little bit of color about me and what I do. I'm responsible for research and professional development at a wealth management software platform for financial advisors. And today I will be talking about the difference between risk and uncertainty, and why the tools to manage risk are actually very different than tools to manage uncertainty. And I thought I'd introduce this, for the talk, this distinction. I consider it to be very important and often overseen in many fields and applications. And I think, frankly, it has like hugely negative, the fact that it's overseen, negative impacts for both firms and individuals that could most of the time easily be avoided. So when I'm going to be talking about risk today, what I mean by risk is mild randomness. So this typically rises in simple systems. As an example, under risk we know the range of outcomes. We know or can estimate the odds of outcomes. So in a sense, the future looks a lot like today. Now, importantly, under risk, a single observation cannot disproportionately impact the aggregate or total of whatever payoff or experience we're under. So under risk, and by the way, examples of risk, here like in the picture, right, is, coin of a flip of a coin or roll of a dice. There's 6 sides. I know if I toss it enough times, each side will, come a 1/6 of the time. Under risk, probabilities are very helpful to manage risk. We can, use all the statistical method fun and optimization, AI, ML, big data, all that. It's very, very useful when we're managing risk. We're a casino. All of these statistical methods are perfectly fine and more than what we need. When I talk about uncertainty, what I'm going to refer to is wild randomness. Typically arises in complex systems. So when the range of outcomes is large and difficult to estimate, the odds of each possible outcome are unknown or not useful. So in a sense, the future does not really look like today. It's always delivering, or it's always going to deliver something new, something unexpected, unforecastable, and most of the time like a big outlier that it's very negative. That's what we're trying to hedge, of course. So here, under uncertainty, a single observation can impact the aggregate or total or experience or payoff in a disproportionate way. So it can basically, one outlier can can ruin us, right? Make us go bust in whatever endeavor we're thinking of. So under uncertainty, probabilities or statistical methods are typically not enough. We need different tools to manage potential threats here. Specifically, we need, some version of a robust heuristic that at the end of the day offsets or nullifies the potential threat. So, to avoid falling into what I'll call fragile strategies, strategies where we think we're under risk and we're managing risk with tools for risk, but we're actually under uncertainty. At a firm level, so, thinking about the problem first from a firm's perspective, of course, at the end of the day, what we want is to avoid having a fragile strategy that ruins some aspect of the business, right? A textbook example of a fragile strategy and a company going bust. Some of you may remember long-term capital management was a hugely famous hedge fund in the 1990s. It had two Nobel laureates, Scholes and Merton, amongst a lot of really, really smart people. And, they were using really sophisticated models. The Black-Scholes formula is one of the most used options pricing models, and modern portfolio theory was, basically the fathers of modern portfolio are Merton and Markowitz. So the point being, they had really smart people doing very sophisticated, models. And they, in 1998, went bust. And here's, a nutshell of basically what happened to that hedge fund. They opened shop in 94. They were killing it for 4 years. Here, and as a comparison, down here is the Dow Jones, and in yellow, US Treasuries bonds. So they were killing it for some years. And then basically wild randomness, kicks in. First here, this first peak was the Asian crisis and then the Russian crisis, and they went bust. Long story short, the New York Fed actually had to coordinate a 3.6 billion bailout because a lot of investors, institutional investors, individual investors had their money here. So anyway, this is kind of a textbook example of what I mean with fragile strategies and when we're managing uncertainty with risk. There's a fun metaphor called the turkey metaphor for describing a fragile strategy. Some of you might know it. It goes like this. There's a turkey and it gets fed for 11 months, and every day empirically indicates that humans care about its well-being with increasing statistical significance. So, like here, all these years of glory. And then, of course, Thanksgiving comes, or the Asian crisis, Russian crisis, and the turkey has a surprise, right? So we want to avoid, being the turkey or being long-term capital management, and first having a lot of success, a lot of efficiency, and then one day, getting ruined, basically. So, yeah, one last comment here is the absence of evidence is not evidence of absence. So I'll discuss this a little bit more in the next slide, but the fact that our model or strategy can be killing it for some time does not mean that we're not under uncertainty and something bad's around the corner. So also, as a firm, of course, we want to avoid getting big hits to the firm. Now for individuals too, as a firm, as service providers, I think it's very important to, especially in the financial industry, avoid providing customers with fragile solutions. And further, not only not providing fragile solutions yourself, but to the extent possible, providing research or educational resources that, make customers aware of these issues so that they can avoid, others that are providing fragile solutions. In my industry, in personal finance or wealth management, this is, of course, very straightforward, like how and why it should be done. Well, the how, maybe not so obvious, but the why. I think there's other industries, given the talks about the big umbrella of finance, other industries in finance where this is relevant, for example, potentially in the pension funds world or broker dealers, asset managers, lenders, to name a few. So here, the decision making under uncertainty is a way that I like to describe risk management or risk modeling better, because it makes the distinction between risk and uncertainty explicit. So consider these two distributions. The blue is a normal distribution, the yellow is a fat tail distribution, and if we zoom into the left tail, the tail risk, and of course the normal converges to zero pretty quick, whereas the yellow doesn't. And the important thing here to highlight is when we have thin tails, in any model where we're assuming our errors are normal distributed or whatever thin tail, we're assuming that the probability swamps the payoff. But in a lot of problems in the real world and wherever there's a complex system, like in finance, we normally actually have fat tails where the payoff swamps the probability, right? So one outlier can wipe us out. So when we want to manage uncertainty and basically do something about this problem, we need to first understand the statistical methods, look at the properties inside the confidence intervals, in the middle part of the distribution, not in the tails. So statistical methods say nothing about the tails. When we want to, manage uncertainty or do decision making under uncertainty, we're required to look at the properties outside the confidence intervals, the tails, basically. And of course, it requires us to nullify or offset these exposures if we do have a fat tail. And candidly, we cannot just say, oh well, let me just parameterize the fat tail and then I'll manage risk that way. At the end of the day, really what it comes down to is we need a method of clipping the tail, making sure that if X goes beyond this point, we're insured, right? Or we're hedged, or we have some way of nullifying or offsetting risk. So another way of looking at this clipping the tail visually, another way of looking at it is, imagine here on the horizontal, horizontal axis, we have X. So outliers happen as we move to the right, and here we have our payoff of X, f of X. So benefit and harm. In a fragile strategy, like imagine this yellow one without being hedged or being clipping the tail. If we have an outlier beyond certain point, we go bust, right? We go to extreme harm. We're concave in harm. And what we want to do by clipping the tail is we cannot change what the world delivers. We cannot change X, but we can change how it affects us. We can change the payoff. We can change f of X. And by clipping the tail, by nullifying or offsetting the exposure, depending on the problem, the solution looks different. By clipping the tail, we make sure that if X is to the right of this point, our payoff never goes below certain level, like here. So this is a robust strategy. This is the fragile strategy. And as a fun fact, of course, usually the distance between these two levels of benefit for small x's for our normal outcomes is the difference between efficiency and resilience. Sometimes we do need to give up a little bit of efficiency to gain resilience, to gain making sure we don't go bust, right? Like when you buy car insurance, we don't expect to crash next year, but we still buy it because we don't want to, have a liability of suddenly, $10 million because we crashed into someone and unfortunately died, or something like that. So, when should we be more cautious about this problem? When we're exposed to wild randomness, when there's uncertainty, when there's fat tails, and our outcome is open-ended. So we haven't clipped the tail. Outliers are unpredictable. We cannot model them. We should instead study the properties of the problem that we have in front of us. So, for example, if we're in certain domain in finance where we know that even if we don't see it every year, but it's a complex system, you can be certain there's a fat tail there. And we need to nullify or offset potential threats instead of just using, quantitative models to try to manage risk. And, concluding, doesn't matter. Well, doesn't matter, but there's a wide range of domains in which we have wild randomness or, some complex system embedded in our problem. Doesn't matter the domain. Can be, at the firm level, the individual level. So we cannot control the outcomes, but we can control how they affect us. We can control our payoff, what we do about that, how we protect ourselves. And I guess at the end of the day, what I wanted to emphasize, because I feel it's something that's, like I was saying, underestimated a lot, is we have statistical methods, AI, ML, big data, all the fun, good stuff. But it's equally important to in some cases, of course, not always. If you're in the casino, you don't need to think about this, but in a lot of cases, and finance is definitely one of them, or a lot of domains in finance where we, on top of that, need to think about fat tails and heuristics to offset or nullify exposures. We live in an increasingly complex world. We just had in the last 2 years, pandemic, now a war in Ukraine and Russia. The world's increasingly globalized, or until very recently now, maybe globalization's, who knows exactly if it's going to backtrack or not, but point being, globalization brings interconnectivity, which brings systemic risk, which brings larger fat tails. And the three takeaways I'll leave you with in order to manage uncertainty are: one, statistical methods have the illusion of managing uncertainty because they don't manage tail risk. Two, if risk is not identified correctly, we don't see that we have a fat tail, and we cannot sometimes see it through data, but if we don't realize that there is a fat tail, we cannot manage risk correctly. And three, good decision-making under uncertainty should study the properties of the problem and find tools that nullify or offset potential threats. And with that, I want to thank you for your time. So that's me, Todd.
Awesome. Thank you so much, Jorge.
Yep.
We'll have time later for questions. Next up is Jerry.
Hi, everyone. I'm going to talk about risk modeling using AI in lending businesses. So let me share my screen. All right. So I'm with Zest.AI, and we address several challenges in lending using AI and machine learning. So about 40% of Americans are difficult for banks and credit unions to score. The CFPB did a study in a few years back that showed approximately 45 million Americans were unscorable using traditional scoring methods because either they had too little data at the credit bureau or no credit bureau record at all. And so these people are simply being left out of the financial system. The tools that are in common use today to assess the risk of lending to a consumer are around 20 to 40 years old. They were invented in the 1950s. And the data that was used to train the models was sort of generated using judgmental methods that reflected somewhat racist practices of the time. Around 83% of our small credit unions take more than 30 minutes to approve or deny a loan. So the level of automation is relatively low, especially compared to fintechs and big banks. And about 50% of the share of personal loans business is being currently taken by fintechs. So this represents an opportunity for credit unions and other lenders to address an underserved market. And sort of this notion that we're leaving people out is pretty well known. The current financial system, credit scoring and credit scores, perpetuates historic bias. Something like 68% fewer African Americans have credit cards. Only 72% fewer Latinx people have credit cards than compared to 85% of whites with credit cards. What that means is that over the course of time, whites are building a credit history, a repayment history that allows them to then go buy a house. And so the credit scoring algorithms that we have in place today reflect biased data that was generated from racist practices in the past, and then was reflected in the credit scores that we use today to make lending decisions, which are ubiquitous. And so we're just kind of piling bias on top of bias, and that gets reflected in our models. And so at Zest, we have a pretty exclusive focus on lending and solving this problem of access. And we help customers of all size, banks, very large lenders, quasi-governmental entities, all the way down to the smallest credit union in Alabama, to help them transform their business using machine learning and AI to do risk assessment on the borrowers who apply for a loan. So why is machine learning so much more powerful? Well, the traditional approach is based on a technique known as logistic regression. And logistic regression was the powerhouse modeling, predictive modeling method that was invented by J.R. Cox in the 50s, and was the impetus for founding FICO. So Fair and Isaac, when they were graduate students at Stanford, were exposed to these techniques and thought that they could use them in financial services to create a more automated method of assessing the risk of borrowers. And the national credit scores were launched in the 80s and were highly successful. The issue with logistic regression as a technology is that it's limited in its ability to model the data and to capture patterns in the data. And it's limited in a couple of ways. So the first is that you really can only use 20 to 30 variables in the model. So think about trying to describe, a loved one in only 20 or 30 words, and ask yourself if you've really created a full picture of who that person is. That's what the credit scoring models have to do. So you have to pick and choose between which attributes you use. And more often than not, when people are building these models, they pick and choose the attributes that are representative of the majority of the population, which means kind of by definition, they're leaving attributes out that might be more predictive of minority populations. And so that limit is really problematic. It also limits the accuracy. So with AI and machine learning models, we can use thousands of variables, hundreds of variables, even millions of variables. I was just at a talk, they were talking about natural language model that had trillions of variables. So these are very large models that are able to express real nuances in the data and then use that nuance to make better predictions. The other constraint in linear models or logistic regression models is that the relationship between the input variable and the probability or score that the model produces needs to be only move in one direction. So it's up and to the right, because the model itself is an additive model. And so, variables can only move one way. And that limits the model's ability to capture reality. So a simple example of this is income. So if someone comes to let's say a high interest rate unsecured installment loans website and applies for a $5,000 loan at 30% interest rate, and they say that they have only a $500 a month salary, that might, or income, that might look pretty risky. As their income increases, let's say their monthly income gets more into the $1,000, $2,000, $3,000 range, then their risk starts to decrease. But if they say that they're making $10,000 a month and or $100,000 a month, and they need a $10,000 loan at 30% interest, that starts to look kind of fishy. And so you get this U-shaped distribution associated with just that one variable reported income with respect to the risk of the applicant. We want our models to be able to capture that type of relationship where it's not just one direction, but it could be up and down depending on the value. And so machine learning techniques allow you to do that. The other issue with the kind of linear modeling approach is that the variables that you use in the model need to be independent and uncorrelated. And this is simply an artifact of the way that the models work. So logistic regression model passes its values through an S-curve, a sigmoid. And so if you pass too high of a value through this S-curve, what happens is that it gets so squished up into the ends of the curve that you can't tell with enough numeric precision the difference between one value or another. And so we call this saturation or numeric instability. And it's a real problem. You can't, if you have that happen, you can't tell the difference between someone who's good and someone who's really good. And so you need to limit the number of variables that are collinear or correlated in the model, which then again causes you to have to use fewer variables, which means you can't paint as clear a picture of the person who you're trying to assess for risk. So this all results in, and machine learning doesn't have that limitation. And so those differences really result in a huge performance differential. So we see up to 20 to 30% increases in approval rates, a 51% reduction in losses. And these are for very large credit risk portfolios. Because fewer variables are used in traditional methods, we also see that compared to traditional methods, machine learning models are much more stable over time. That's because they don't rely on one or two factors or dozens of factors, but hundreds of factors. And so if one or two of those factors starts to mean something different because the government changes their mind about whether or not you can report delinquencies on a mortgage, or whether or not, or incomes start to change because now people have stimulus, that ends up being one of several thousand factors that are in a model, not the only factor that you're relying on to make the risk assessment. And so by having lots of redundant sources of information as inputs into the model, we see that the models could be more robust over time. So here's kind of an illustration. This is a real example comparing a benchmark credit scoring, sort of a traditional credit scoring technique with a machine learning one. And what you can see on the chart is that at every bad rate, so lenders think about their lending business in terms of how many people can I approve, and then of the people I approve, how many of them eventually go bad, they don't repay. And so risk modeling in lending or in finance businesses is really all about balancing your profit that you earn from the interest associated with the loan that you've extended versus the cost of risk. In other words, the amount of money that you lose when someone doesn't repay you. And so what the chart shows is that at every level of every risk tolerance, every level of bad rate, so here 1%, 2%, 3%, 4%, 5%, the machine learning model is able to significantly improve approve more people. So if I hold my risk constant at 3%, for example, I can approve twice as many people compared to the traditional model. So that's a pretty significant shift in the business, because now instead of issuing $10 million worth of loans, you can issue $20 million worth of loans and hold the risk rate constant. And so that allows lenders to say yes to more people that would have been denied previously, but it also allows them to make more profit from the loans that they make and do it safely without incurring more risk. So the borrowers that these lenders are able to approve end up being very loyal because everybody else is using the traditional methods, and so when someone grants them a loan and they've been denied everywhere else, they become customers for life. It's interesting that when we look at the risk prediction results, when we aggregate by credit quality, we see that the results are improved across the board. So when a lender thinks about their applicant pool or the paper that the loans that they've issued, they tend to think of it in terms of grades. There's A paper, which are loans that are highly likely to repay, B paper, which may repay at a little bit of a lower rate, C paper, and D paper. And so when we pull these apart and look at the accuracy, the statistical accuracy here measured in area under the receiver operating characteristic curve, we see that there's an increase at every risk tier. So some people think, well, AI is really great at differentiating people who are more risky, but actually it helps you identify people who are less risky as well. So what does this translate into in terms of business results? So one of our early clients was Discover Financial Services. They used us to power their unsecured personal loans business. They had been hit by a ring of fraudsters, and we were able to deliver a pretty significant reduction in risk by using machine learning to power their underwriting decisions instead of the traditional methods. The model that we put in place uses thousands of variables and multiple modeling techniques in order to deliver this huge increase in performance. But we can also use the models to increase approval rates. So one of our early credit union customers, ViStar Credit Union in Florida, used the models to increase their approval rate by around 22%, reach people in the community that they were saying no to, increase their membership, and issue about $40 million per year in additional revolving product. So that'll be an annuity that pays them dividends over time, because credit cards end up generating a significant profit over the lifetime. That model also used around 500 variables, so they were able to paint a much clearer picture of the borrower and be more accurate in the risk assessment. But if we say yes to more people, does that mean that we're saying yes to all people at equal rates? Not necessarily. In the case of one of our customers' models, this is what happened. We can use the mathematics of game theory to understand what's driving the model's decisions. Machine learning models often get the reputation of being a black box, but if you use the right rigorous techniques, you can actually unpack that black box and understand what's driving each and every decision. And you can also understand what's driving differences in outcomes for different groups. And so here we're looking at each of the factors in the model: a credit score, a loan to value amount, a down payment amount, a monthly income, count of bankruptcies and delinquencies, and their contribution to the accuracy of the risk score. Here, credit score driving 32% of the accuracy. The unfortunate thing about that variable credit score is that it's also driving 28% of the difference in approval rate between people of color and whites who apply for this mortgage loan. And so that leaves lenders in kind of a sticky situation if they want to improve the fairness of their outcomes. they have to either go out of business because they make bad loans, or continue to turn away people of color at higher rates than their white counterparts. And so we set off to sort of solve this problem that by searching for methods that are able to search for less discriminatory alternative models that make better trade-offs between fairness and accuracy. And so the result of one of our search processes is displayed on the chart on the screen. We pioneered this method called adversarial de-biasing that's able to take a model and essentially take the bias out through an adversarial process that I'll describe on the next slide. What you see here is that the original model was at about a 0.82 AUC, but was only was saying no to people of color at about 20% more often than their white counterparts here. When we search for less discriminatory alternatives, we can get all the way from around 83% all the way up to 93%. So much more fair, 10 percentage points in fairness, while only trading off a couple points in AUC. So for, maybe $1 or $2 of profit per loan, we're able to be significantly more fair to the people that we want to reach. And so we're really proud of this work. It's used in every model to make sure that the models that we put out into the world are the most fair that they could be, and that they're treating everyone equally. So how does that work? Well, we borrow a page from a technique known as generative adversarial networks, which was pioneered by this guy named Ian Goodfellow. The adversarial techniques were used to generate deep fakes and some of these interesting examples that you see in the computer vision literature. Here we're using an adversarial training process, which is going to take the bias out of the model. And so what we do is we set up a competition between these two models. The underwriting model on the left is trying to underwrite risk and be as accurate as possible. The model on the right is trying to guess race and ethnicity on the basis of the first model's risk score. So if that secondary model, the adversary, can guess that you're white if you have a high score and guess that you're not white if you have a low score, that's a problem. It says that that original underwriting model is pretty racist. And so then what we do is we feed back that information into the other model in the form of a linear combination, its loss function. So by combining fairness and accuracy into the model training process, we're able to generate that efficient frontier of less discriminatory alternative models that make it possible to approve more people of color without taking on additional risk. So the results of that process are shown on the slide here. We were able to help this lender increase their approval rate for Hispanic and Black applicants by over 40%, for female applicants, single female applicants by 36%, and 30% for elderly applicants. So significant movement in financial inclusion for these people who have been historically excluded from the financial services, needlessly, because of just less sophisticated risk modeling techniques. One of our customers has been pretty vocal about the result. Green State Credit Union in Iowa was able to increase approvals for protected borrowers by 30% across the board, originate 132 million in more loans, and generate 11 million in more profit that they could then invest in their community. Credit unions are nonprofit cooperatives that are chartered to serve their communities, and so it's a core to their mission to increase inclusion and to address people who have been historically excluded. So that's kind of what we do at Zest, and thanks for listening, and I'll turn it back over to you, Todd.
Thank you so much, Jay. So now Maciel will come on, and so will Jorge, and we'll have a fireside chat.
Hi all, My name is Maciel. So sorry, I had to actually fix something really quick. First of all, hello. First of all, I just want to say thank you so much to both Jorge and Jay for your presentations. They were absolutely incredible. I've learned so much already. I have to say that this is an absorption period for me in this field, and I couldn't applaud you guys more. We did have some questions come in, so for each of you individually. And so I will ask a few questions directly to each of you, and then kind of do one that you guys can both answer together. So the first question that came from the audience is for Jorge. It is, in situations where even describing all possible outcomes is fundamentally very difficult, i.e. COVID, climate change, sentient AI, what sorts of strategies can be used to hedge against uncertainty?
Yeah, so at the end of the day, the way I think about it is when we want to clip that left tail of the distribution, we have to, at the end of the day, nullify or offset risks. And there's really painting like a big brush, 4 methods. We can hedge, we can insure, we can diversify, or we can have reserves, liquidity management. So depending on the problem, if it's an investor, an individual investor, or if it's a firm, or depending on the problem, how that solution looks like, it's different. But those are the 4 broad ways of ensuring that when that wild randomness comes along, whatever form it takes, it doesn't wipe you out. It's going to be a combination of those 4 things.
Yeah, I just add to that real quick. Right.
Yeah, please.
The other thing you do is stress test, right? So come up with as many different weird scenarios as you can and sort of see what would happen under those scenarios. So there's whole departments that at financial institutions that think really hard about catastrophic events and what would happen as a result of them. And so while I agree with your assessment, Jorge, that modeling outliers is hard and kind of impossible, really, you could still try, and at least in that process, you might be able to learn something.
Awesome. So then moving on to the next question. This can be for both of you guys too. How, if you were to put a number between 1 and 100 of how far AI has essentially been implemented across fintech, what number would you give and why?
I'll leave that one to you, Jay.
I think maybe 10. So I think some of the largest institutions are doing this in kind of force. The smaller ones are starting to dip their toes in, and then some of the more conservative ones have been very reluctant. And I think that's just an artifact of a couple of things. One, the technology is relatively new in the grand scheme of things. When you think about logistic regression from 1957 to 1986 or something, it took to get a national credit score done, right? And so that was 30 years of incubation. So and then it spread like wildfire. So I think we're in that sort of it's spreading like wildfire stage, but it's in the sort of early stages of that.
Yeah, I really loved how you broke down how for the FICO score, there's only about 20 to 30 variables versus AI can then provide hundreds, if not more. And I think that really does give a lot more color and texture to, what every individual consists of and how that's being run not only here nationally, but internationally.
You'd be surprised that, we talk to machine learning practitioners and you say 1,000 variables, they say, that's so little. You talk to a bank and you say 1,000 variables, and they say, how am I ever going to get that through my compliance department? So there's a difference in culture there.
Yeah, absolutely. So a question for Jorge. You had mentioned that, let's see. Oh, in your slide, managing uncertainty, you mentioned that you need to analyze properties outside of the confidence intervals. How do you define what gets clipped on each tail, or what gets clipped?
How do you define what gets clipped? So I'm not exactly sure I understand what the question is, but let me see if I can try to get what the issue is. So I guess the question is, if we are in a domain where if something goes beyond some threshold, something bad happens. That's a good candidate of where to clip the distribution, right? For example, what Jay was mentioning of stress testing, maybe we find out that through stress testing that if these combinations of factors of x's occur, my payoff, my f of x gets really bad. Well, then I want to make sure that if the x's that create those combinations of factors go beyond that point, I'm protected either through insurance, hedges, reserves, whatever it is. So yeah, I hope that answers the question. I'm not entirely sure.
If it
Okay.
didn't, I'm sure it did.
Okay, great.
I'm sure it did. And then, I definitely, for anybody that's listening right now, if you have any questions that you haven't submitted to me, we had only gotten a few, feel free to submit them to me right now. But I guess for the guys.
I'm sorry.
No.
I was going to say, I was going to make a joke. I thought Jorge was going to teach us about the student's T distribution and Monte Carlo sampling, but we can save the math for later. Sorry, I couldn't resist.
No, please go for it anytime. I would say, I really, for Jay, I mean, in your presentation, you really went over all about what Zest is able to provide. And I was honestly learning so much just about how we've transitioned from the FICO score to now and just financial inclusion overall. And, as somebody who's learning AI very briefly, it's incredible to see that this is something that can be widely implemented. And I just encourage all those listening here to kind of dive in and to educate alongside, myself, if you're not farther along than I am, which I'm sure you are if you're here. And then I just want to give the both of you guys the opportunity to just kind of describe what helps push you, to just keep diving in to discovering more when it comes to artificial intelligence.
Okay, do you want to take that first while I think about it?
Yeah, sure. So our customers, tell us their problems, and the issue related to fairness and accuracy and the trade-off was one that was we were aware of, but didn't realize kind of the complexity. Because look, at the end of the day, you can have a very fair, quote unquote, fair credit system by just giving everyone a loan. But then the people that you give the loan might not repay. And when they don't repay, then maybe they go bankrupt and you kind of ruin their financial situation for years. And so you can't do that. You have to be accurate and fair. And so that setting up that problem was something that our customers kind of taught us. And then we just were kind of relentless about trying to figure out how to do it. And even to this day, we see the opportunity to improve beyond what we've done so far. So we're searching for more and more efficient ways to make the trade-off between accuracy and fairness so that we don't have to give up any accuracy in order to create significant fairness increases. And then, we're constantly looking for new data sources and new techniques to try so that we're able to stay ahead of some of these very large companies that are, kind of nipping at our heels. So to answer your question, what motivates me is, making sure that our customers are successful, making sure that we're treating consumers right, that we're trying to right the wrongs of the past, and also that that we're staying ahead of all the competition.
Yeah, I mean, on a similar line, and the reason why at first was kind of like, what am I going to say is because, like I mentioned to Todd when we first touched base, my focus more on the kind of AI side of things is on the building financial structure side of things. So to me, too, the motivation of what our company is doing is really trying to change how financial advice is done. And change it from like a simulation, mean variance based way into a financial structure management way, which is more comprehensive, holistic, robust, thinks about everything surrounding the individual, not only his portfolio and not only like a subset of things. So yeah, I mean, it's a similar motivation. It's really trying to change how advice is done and you know, help advisors to learn different and better methods, and then provide them the tools, the software to actually go and implement and deliver that advice. The funny part is that in my case, it doesn't really rely on modeling as much as on methods, on a change of paradigm.
Yeah, amazing. I think that's 100% true. When people know that they have the opportunity, and when they know that they have the capabilities to take out a loan to buy property, to create a business, to things that they may not have necessarily envisioned for themselves, they work towards making that happen. And then when the ceiling breaks for a majority of people, you know, the opportunity is endless. So we have more questions. So another one for Jay. You mentioned adversarial components to your system. Are you using an agent-based actor, critic, RL framework? If so, how are you defining the environment and state?
Yeah, that's a great question. So it's not a reinforcement. This approach is not a reinforcement learning approach. So although I've been thinking a lot about that. So this approach is really just a simultaneous training approach where, yeah, so if you know how a neural network training process works, it looks at batches of data at a time, and maybe 1,000 records or 10,000 records. These are called training epochs. And so after each batch of training data is processed by the learning algorithm, the backpropagation algorithm is used to then go update the gradient of the model. And the gradient of the model is just the decision surface. So it says, to the left or the right, you're in one class or another. And these risk management models are for commercial credit or personal credit risk are good, bad classifiers. So is this borrower a good borrower or a bad borrower? It's a binary classifier. So after each training epoch, I'm going to go update that gradient. How do I update that? Well, I compute what's known as the loss function for the learning algorithm. Typically in classifiers, you use a metric called log loss. You know this, you're studying it, right? But in this system, instead, we're training an adversary at the same time based on the output of that first model. And so what we could do is we can compute a different loss. We can compute a fairness loss. And so before we go update the gradient on the original classifier, we can combine the loss function, the loss values, and create a different decision boundary, one that's more fair and as accurate as possible. So that's kind of how it works. It's not reinforcement learning in the sense of I have an environment and I have agents running around in the environment generating training data. But it's similar in spirit because I have this other thing that's sort of providing feedback to the system. Where we are thinking about using reinforcement learning is in simulating what could happen to borrowers who've never taken a loan before, because the credit data that we have today is based on loans that have already been granted. And so if you're in the population that's never gotten a loan before because you're new to country or you're really poor, it's kind of unclear how to make that assessment based on a history because there is no history. So you have to kind of generate it. And so one of the things that we've been thinking about is using historical cash flow data to create a simulation to say, okay, if I gave someone a $100 a month obligation, would they have been able to pay it if I granted it to them 2 years ago? Would that have been able to pay based on their balance history? So that's a way that we're thinking about using reinforcement learning.
Great. That's a great question for whomever asked that. And Jay, you have another one. Are you ready? Okay, so this one is, do the kinds of problems Jorge described, fat-tailed distributions, high uncertainty leading to potential ruin, crop up in your work at Zest? And how do you deal with them?
Yeah, absolutely. So that's a big worry, right? So when we train the models, I mentioned before that there's so many people that aren't represented in the training data because they've never been given a loan before. So these are known as rejects or sort of unfunded applicants that create what is known as a blind spot in the training data for the model. And so we can't really trust the score that the model is going to assign to these people because it has no basis in history to be able to generate that score. The algorithm runs and it generates a number, but that number has no basis in reality. Okay. And so Jorge's framework of understanding certainty, I think, is really helpful in that sense, because we need something else. It's not just what the model says. We need another layer that says, should the model be saying anything? And so as part of what we do in our work with banks and credit unions, we monitor the inputs that are coming into the model to see if they're similar enough to the data the model was trained on. If they're not, then the model really has no business generating a score. And so we raise a red flag and we say, look, something has changed in the world. You're getting a lot of applicants that don't look like the historical applicant pool. Are you sure that you want to be using this model on that population? I think that's a best practice for modeling. And a great example of when something can go wrong was the 2008 financial crisis, where models were used to score loan applications that weren't in the training data. They were totally different types of loans. And that led to Dodd-Frank, and it led to a framework that the federal government created called the Guidance on Model Risk Management, that requires banks and lenders to do this kind of monitoring just so that they can avoid that type of situation from happening again.
Great.
Also, if I can add something, I loved your response, Jay. One thing that I didn't include in the slides because there was no time. There's so many fun things, but in the example of like when we walk from risk to uncertainty, from the casino, from rolling dice to complete uncertainty, one step away from throwing dice towards uncertainty is, let's say, a car insurance company, right? I'm insuring a bunch of cars, but they're all them crashing is independent from each other. So it's not a complex system because they're independent. So they're not all going to crash at the same time. So I can estimate with a lot of accuracy. I know how much a car is cost to repair, and unfortunately a person too. So I have a very good estimate, right? But then if I walk further, think about a reinsurance company, right? Like suddenly now everything's correlated, right? A tornado passes through some place and I'm reinsuring all those companies there, I blow up. And I think, maybe correct me if I'm wrong, Jay, but I think in the business that you're in, I mean, everyone's independent to an extent, because it's not like a hurricane comes and wipes everyone out. But like you said, there's things like 2008, things like prolonged adversity, like in Japan, 30 years have passed, and if you bought a stock in Japan 30 years ago, it's still 70 cents on the dollar. Wars, pandemics, cyber attacks, all these kinds of things.
Right, global pandemic is a great example. Exactly.
Right. And then that's the point, right? At some point, all your models had an idea, and then some of these things happen, and then no one pays. You need reserves, liquidity management, hedges, insurance to the business be able to survive.
No, that's exactly right. So that's why banks have this. There's a regulation called CCAR that requires that you model kind of these worst case scenarios so that you can know how much cash to have on the balance sheet in case all the loans go bad or some significant portion of the loans go bad. And it's also why the OCC, kind of insists that banks keep a good ratio, a nice portfolio ratio between unsecured and secured and different types of, commercial and retail products, so that they don't have too much exposure to one sector where a black swan event could really take them out. So that's exactly right. You have to have a risk management kind of mindset around all this stuff, because if you're overexposed in one sector or in one geographic area, et cetera, you can really be taken out.
All right, so we are approaching the end, but I think for any other additional questions that come in, and if there's anybody that's interested in talking to you both further, what would be the best means of connecting with you? LinkedIn?
Yeah, you're welcome to email me. I'm the letter J at Zest.AI. So it's pretty easy to remember. And I'm on LinkedIn as well. So
Same here. LinkedIn works for me, and my website's my name, Jorge.Tarraso. So yeah, LinkedIn's probably best.
Well, you both are phenomenal. Just sources of knowledge. Thank you so much for sharing your presentations and this information on behalf of all of us. There's a lot of thank yous that are coming in from everyone and or privately. So I just wanted to express that, and I'm going to hand